Good afternoon, everyone. This is Steve Janikowski, Chief Investment Officer at Brower & Janikowski. Recently, we held a client event where we discussed interest rates, the Federal Reserve, the bond market, the interest rate environment, and what rising rates may do to the bond market. Not everyone was able to attend this event, and some of our clients are out of state and even out of the country, so we decided to record the content from the client event into this webinar format, which we will post on our website. The Federal Reserve has announced that they plan to begin raising interest rates to reverse their long-term low interest rate policy that they began in 2009 after the Great Recession. This has many investors wondering, what does this mean for interest rates? When will they begin going up? How much will they be going up? What does it mean for bonds? Will bond values go down? And if they do go down, does it make sense to own bonds at all? Should we sell all our bonds? If you've been following the financial media, the media and the Federal Reserve indicate that the economy seems to be growing nicely and that inflation is moving up modestly, that the Fed will begin raising interest rates soon, and that as a result, bond yields will go up and bond values will go down. And this may be the time to get out of bonds if we're moving into a bad environment for bonds. Our views are quite different from the consensus. We believe that economic growth is relatively weak and inflation is not moving up and is not a problem at this point. That contrary to the view that it's time to get out of bonds, we feel there are plenty of opportunities in bonds and that bonds will be a solid investment going forward. And more importantly, bonds will be great shock absorbers, as they always have been, and we'll explain in a few minutes what we mean by this. The key questions on everyone's mind are, will interest rates go up? When will the Fed Reserve begin raising interest rates? And how high will interest rates go? The answer to the question, will interest rates go up, is yes, interest rates will go up, but let me first differentiate between short-term interest rates, which are determined by the Federal Reserve, versus the intermediate and longer-term interest rates of the bond market, which are really determined by economic activity, including growth rate and inflation. So the Federal Reserve is going to raise short-term interest rates, which is the federal funds rate, from 0.25%, and they would like to see that up in the 2 to 3% range fairly soon. This is really unwinding ZIRP, or zero interest rate policy. Unwinding ZIRP, or raising the federal funds rate, will have the effect of raising short-term interest rates on things like money market funds, CDs, and treasury bills, but may not have an effect on longer-term interest rates in the bond market, such as intermediate-term bonds or other longer-term bonds. This chart, while a bit busy, illustrates the interest rate policy of four of the largest central banks around the world. The top in gray is the Federal Reserve, the blue, Bank of Japan, the lighter blue, the European Central Bank, and in purple, the Bank of England. Notice that in 2009, all of the interest rate policy guidance from these central banks went to almost zero, or very low rates, and is held steady or declined all the way through the present. The fact that central banks have kept rates so low for so long illustrates their concern about the weakness in the global economy. And what's more interesting is that this is almost unprecedented, that central banks would keep interest rates so low for so long. The Fed's easy money policies have given a tremendous boost to both the stock and real estate markets. And although the Fed has announced that it is going to begin raising interest rates, it's delayed and dithered on raising rates. Why is that? In our view, it's because the Fed is concerned that as it begins to raise rates, it will trigger a correction in the stock market. Investors have been trained to pay very close attention to the actions of the Fed Reserve. And when interest rates begin to go up as the Fed raises them, often investors will sell stocks The market is driven by liquidity, so rising rates are bad for the stock market, whereas falling rates are good for the stock market. Janet Yellen is very conscious that investors are paying very close attention to the Fed's actions, and as a result has been very cautious about raising rates. As I've mentioned, the Fed keeps pushing out when it's going to begin raising interest rates. Now we have a federal funds rate of 0.25%. The federal funds rate is the rate that the Fed lends to member banks overnight, and it's often used as a benchmark for pegging all short-term rates. The Fed funds rate, however, should be trading somewhere at a range of the rate of inflation or slightly higher. And if the rate of inflation right now is about 2%, we would expect the federal funds rate to be somewhere between 2 to 3%, yet it's still at 0.25%. This chart, and where you see in the red circle, the blue line illustrates where the Fed Reserve recently announced it believes the federal funds rate will be going over the next several years. You can see it going from 0.25% up to about 3% over the next several years. The purple line below the blue or green line reflects what the market believes the Federal Reserve will do in raising interest rates. Notice that the market does not believe the Fed will begin raising rates as quickly or as dramatically as the Fed has announced that they might. And why is that? Well, historically, and in almost all cases, the Fed has been overly optimistic on economic growth and the rate of inflation. And so the market doesn't buy that rates will go up very quickly. The number one question on the mind of the Federal Reserve is, how do we raise the federal funds rate without triggering a correction in the stock market or concern that the Fed is tightening and it might choke off economic growth and possibly toss us into a recession? The reality is that even if the Fed funds rate were at 2 to 3% today, in our view, it wouldn't have any appreciable negative effect on the overall economy. After all, the Fed funds rate is artificially low and should be trading somewhere in the 2 to 3% range at this time. The problem for the Fed is, how do we get there without triggering concern and panic among investors and consumers? I had this amusing vision of Janet Yellen holding a magic wand where in the middle of the night, if she could wave the wand, suddenly the federal funds rate would be trading at 3% with no one the wiser, and when we wake up in the morning, everyone would feel that at 3% the Fed funds rate is where it ought to be. So how is the economy doing? Is it really getting stronger, as the Federal Reserve and the media have indicated? And are higher bond rates justified? Is growth and inflation moving up fast enough to justify interest rates in the bond market going up? So let's take a look at how the economy really is doing. This chart shows the economy's growth in gross domestic product, or GDP, on a real basis, meaning after inflation. So the economy has been growing since the 60s at about a 3.1% clip, or a trend line. You can see that it's fairly consistent all the way up until around 2009 when we hit the Great Recession, and then economic activity dipped. Now, notice in 2009 when it dipped, this is the time that the Federal Reserve started its vast programs of monetary easing, including quantitative easing and zero interest rate policy. And with that tremendous amount of monetary boost, we would have expected the economy to perk up. However, that didn't happen. The economy has stayed at a fairly low rate of growth, approximately 2%, and appears to be decelerating rather than accelerating. Also, inflation hasn't picked up. The Fed had been attempting to increase economic growth and increase the rate of inflation, but as you can see from this chart, inflation has actually been declining, and we've been moving at about a 2% inflation clip for the last 13 or 14 years or so. This chart shows the yields for U.S. Treasury securities on the left side of the chart, very short term. You'll see 3-month, 1 year, 2 year, 3 year, and so on, and to the far right, 30 year. This is called a yield curve because it reflects the yields of this distribution of Treasury maturities from 0 to 30 years. And you can see that it steeply rises from the short-term maturities up to the longer-term maturities. When the Fed Reserve begins to raise the federal funds rate, it will push up short-term interest rates. So in our view, short-term rates such as 3-month, 1 year, 2 year, 3 year securities, those rates will begin to go up. The question is, what effect will it have on intermediate and longer-term rates? As I mentioned earlier, with low inflation, low growth, and no prospects for rising inflation or runaway growth at this point, in our view, there really isn't a great argument for intermediate and longer-term rates to go up. So the risk to bond investors, in our view, is on these shorter maturities. Most people feel that if rates are going up, perhaps we should get into short-term bonds. Well, this could be actually the wrong solution because that's where rates are most likely to go up. And if anything, intermediate and long-term rates, until we start to see stronger inflation and economic growth, are likely to stay relatively benign. And there is precedence for interest rates staying low for a very, very long time after coming out of a very, very weak economy. Going back to the 1800s, in this chart, you'll see that interest rates stayed very low for about 31 years. And in the 1930s, following the Great Depression, you'll see also that interest rates stayed very low for about 32 years. Both of those periods have the dotted gold line around them. Then rates skyrocketed during the 70s and have fallen consistently from 1981 to where we are at present. People automatically assume because rates are so low relative to where they've been over the last 30 years that they need to go up again. And history tells us that that's not necessarily true. Rates could stay low as long as inflation and economic growth stay low. So that rising rates for bonds in the intermediate and long term may not be the super problem that most investors are worried about. Our bond portfolios are yielding approximately 3.4%, which, as you saw from the previous slides, is a very competitive return with interest rates as low as they are. Even so, I often hear comments from clients such as, "Steve, bond returns are so low. Can't we invest in something that pays us more? Are bonds really necessary in the portfolio? Shouldn't we dump our bonds and perhaps move the money to something that's going to pay more or have higher growth potential, such as stocks or something else?" And one extremely important point is, although bonds have a yield and we're obviously interested in the interest rate that the bonds generate, the purpose of bonds in a portfolio is not just to generate income, but it's also meant to be a shock absorber, which I'd mentioned at the beginning of this presentation. So for bonds, it's not just about the current yield, whether they're attractive or not attractive. In our view, they have an absolutely imperative place in every portfolio that is concerned about stability of principal and weathering stock market shocks. Bonds have shown unique qualities of being shock absorbers in a portfolio, and they are the investment of choice during stock market declines and recession. And the reason is simple. When the stock market goes down, investors get nervous, sell stocks, and move the money into what they consider safe havens, which would be cash, CDs, treasury bills, and also bonds. Bonds generally go up when stock markets go down because the demand for bonds goes up as investor money flows into bonds in the bond market, pushing up their prices. So we get a nice double benefit from owning bonds during a market decline. One, we're earning the interest, and two, it's helping to cushion the stock market blow to the portfolio. And there is actually a third, which is there's some potential for capital appreciation as bond prices go up. And even though this presentation is about interest rates and the bond market, and not the stock market, I thought it would be useful to show where the stock market has been over the last 30 years. And I've categorized it in this chart, which shows the three major stock rallies over the past 30 years. The first in the late 1990s, which was the internet tech bubble, which ended badly in 2000 and crashed about 50% in 2003. And then we had the subprime housing bubble, very, very strong rally from 2003 all the way to 2007 when the start of the Great Recession hit, and a calamitous drop in value, about 57% in the market, which bottomed in March of 2009. And then we've had this whole QE boom, which stands for quantitative easing, which was one of the monetary policies or easing policies the Fed Reserve employed in addition to ZIRP, or zero interest rate policy. Now you'll notice at the very far right, at the top of this peak for the stock market rally, I have a question mark. I'm not suggesting the market is going down tomorrow. In fact, no one knows when the stock market's going to go down, although it is interesting that this market has been so powerful, we have not had a correction since 2011. And if you'll notice, even with the corrections from 2009 when this rally started have been relatively benign, we have not had any significant retrenchment in the market prices. Market values right now are at the fairly high end of their range. Again, just because they're high doesn't mean they'll go down, but stocks are not cheap at this point. And when the market does go down, and it will, we will have a correction at some point, it will be very nice to have shock absorbers in the portfolio, and bonds will have a very, very important place in your portfolio to help weather the storm. The interesting thing is shock absorbers aren't universally essential to all investors. They're important to some investors and less so to others. So shock absorbers are less critical to what I'll call accumulators. And these are investors who may be earlier in their career. They're saving money on a regular basis, adding to their portfolios, and they have many, many years ahead of them in their career where they can continue to save, ride out the ups and downs in the stock market, and not worry about having to cash in at a bad time, because they've got many, many years ahead before they actually start using the money. This chart is an illustration of how it could look for someone who's an accumulator in different types of portfolios. And the reason for this chart is to make the point of what shock absorbers will do for an accumulator versus the opposite, which is someone who is now in the spend mode, or someone who's retired and drawing from the portfolio. In this chart, it's a hypothetical chart showing three investors each having $1 million, but adding $50,000, which are the gold bars, to their portfolio religiously every year over the next 25 years. You'll notice the green line is a very, very smooth line. That is a mythical portfolio. It doesn't exist. A steady year in, year out 7% return. If anyone knows of any place we can get this, please let me know. But you'll notice that grows very nicely over the 25 years, very steadily. The blue line is a simulation of volatility for a portfolio comparable to the Standard & Poor's 500. So 100% stock portfolio with volatility similar to the S&P 500. And the red line, again, is a 100% stock portfolio with simulated volatility to something more volatile than the S&P. It's getting closer to a NASDAQ type portfolio. Notice with the two stock portfolios, they go up and down with market movement, and they have some significant declines, but they continue to trend up steadily, and at the end of 25 years, almost end up in the same place as the steady Eddie 7% year in, year out growth portfolio. And incidentally, the stock portfolios are also growing at a compound average rate of return of 7%. So all three portfolios are growing at the same rate. It's just that some have more volatility than others. So for an accumulator, having the shock absorption capability in a portfolio, as long as they continue to add money and have a long-term time horizon, is not as necessary or as important. But let's take a look at who it might be important for. Shock absorbers are critical to spenders, retirees, and those who are approaching retirement. In other words, the accumulators, we would say, have positive cash flow, whereas people who are spending or drawing from the portfolio have negative cash flow. This chart is, again, a simulation of what a portfolio might do for a spender or someone drawing on their portfolio. These three portfolios in this chart are the identical portfolios that we use for the accumulators, with one important difference. Instead of adding $50,000 a year, these portfolios are taking a withdrawal of $50,000 in year one, but then growing that, in other words, giving themselves a cost of living increase of about 3% a year over the next 25 years, so that that $50,000 withdrawal rate is now $100,000 25 years from now. All the returns are identical to the previous chart. The green line is growing at 7%. The blue line with the S&P volatility is also growing at a compounded 7% rate. And the red line is also growing at a compounded 7% rate. Well, why is it then that the green line pretty much holds its own over this 25-year period? $1 million portfolio with all these withdrawals is still worth close to $1 million, whereas the stock portfolios, the more volatile they are, the more they've declined in value. In this case, the blue portfolio is worth about $646,000, whereas the red portfolio is only worth $135,000. Now, why on earth would those two portfolios have gone down so much more than the green portfolio? In a word, it's because the investor is steadily taking money year in, year out. But however, when the market goes down, as you see where there are dips in these portfolios, that's a time where, as you take money out of the portfolio, it's not there to rebound and get back to its previous value. So this consistent withdrawal pattern coming from a portfolio really hurts the results with market volatility. And you can see the more volatile the portfolio, the worse it's going to impact the portfolio results. And this is where I mentioned that shock absorbers are absolutely critical to someone who's in the spend pattern, because the more they can keep a steadier portfolio return in their portfolio, the better the results are going to be as they take normal withdrawals from their portfolio. So someone who is in this retirement mode, it's essential that they have ways to reduce the amount of volatility in the portfolio. And even though there are other investment vehicles we use, such as alternative investments, there's nothing that's quite a substitute for bonds. That is, they generate yield, current income, go up in value often when the market goes down and when we go into a recession, but also help cushion the blow of reducing the volatility in the overall portfolio. Which brings us to, how are we navigating this environment? So we are in a volatile environment, and we are likely to have a stock market decline at some point, and interest rates, we know, are going to go up. Remember, I mentioned the Fed Reserve raising the Fed funds rate is a technical change in short-term rates, which will impact short-term bonds, but in our view will not impact dramatically intermediate and longer-term bonds. We view this environment in two ways. One, we want to be opportunistic to maximize the yield in your portfolio, but we also recognize that there are bad things that could happen around the world. The Middle East hasn't changed. It's still a hot spot. We still have the same problems in Ukraine. There are risks that the fallout from Greece and whether it exits the Euro or the EU. And there are other types of problems that could trigger sharp increases in interest rates as it did in 2008 and 2009. So being cognizant that bad things can happen, even though our view that the economy is relatively weak, inflation is weak, and therefore interest rates are likely to remain low for intermediate and longer term bonds, we still don't want to be out on a limb if there is an interest rate spike or shock to the credit markets. And therefore, we've looked at protecting capital in your portfolio by maintaining a relatively shorter intermediate duration in the portfolio, and which would cushion us from big shocks in interest rate increases or other disruptions to the credit markets. Let's take a look at the bond market. As a baseline, we're going to look at the total U.S. bond market, and we're using the Vanguard Total Bond Market Index Fund as a proxy for that. The Vanguard Total Bond Market Index Fund currently has a yield of 2%, which is the blue bar, and a duration of 5.6 years. What in the world does duration mean? Well, duration is another variant on maturity. However, maturity includes only return of principal at the time the bond matures. Duration includes the return of principal at maturity, but also all the intervening coupon payments or interest rate payments that happen from the time the bond originated to the time the bond matured. Why is this number interesting? We use it as a gauge of risk in a bond or bond portfolio. In other words, as a rule of thumb, if a bond or bond portfolio has a duration of 5.6 years, if interest rates go up 1%, that portfolio or bond will drop approximately the amount of duration expressed as a percentage. In other words, I would expect with rates going up 1%, this bond portfolio would drop 5.6% in value. How would that translate if an investor bought the Vanguard Total Bond Market Index Fund at the beginning of the year and interest rates at the end of the year were 1% higher? Well, they would have earned approximately 2% in yield, and the portfolio value would have dropped about 5.6%, meaning the net return would be 5.6 minus 2, or have a negative return or a loss of 3.6% for the year. So now let's look at how we've constructed your portfolio. We'll take you inside our research room and show you step by step how we've thought about combining a series of different mutual funds to increase the current yield in the portfolio opportunistically while keeping the interest rate risk low, significantly lower than the overall bond market. I'm going to take you through a series of slides. Each slide is going to reflect the addition of a new mutual fund in the portfolio, which will show its current yield as well as its duration. And then as we go through slide by slide, as a layer in each of the next funds, you'll see how it affects the overall yield and duration for the portfolio. Keep your eyes on the blue and the gold bars to the right, and watch how yield changes and duration changes with the addition of each subsequent fund. Now, for compliance reasons, I'm not using the actual names of the funds. However, the generic names I'm using in this webinar depict the actual funds that we are using in your portfolio. First, we'll start with Core Bond Fund. This fund is a very broadly diversified portfolio of fixed income securities, both U.S. Treasuries, mortgage-backed securities, corporate bonds, a small amount of high yield, and a small amount of emerging market bonds, as well as foreign bonds. It currently has a yield of 2.6% and a duration of 6.2 years. So if you look again on the far right, the yield bar 2.6, duration 6.2. Watch these change as I add additional funds. Next, we add Specialized Mortgage Fund. This fund has a yield of 3.7% and a duration of 3.4 years. This fund invests exclusively in mortgage-backed securities, both issued by the federal government agencies as well as from private investors. The duration for this fund, however, has reduced the overall duration in the portfolio, and also the yield being higher than the previous core bond fund has boosted the overall yield for the portfolio. Next, we've added a tactical bond fund to the portfolio. This is a fund which we consider to be a shock absorber in the portfolio and a go-anywhere fund that can take advantage of all different types of dislocations in the bond market. What does that mean? It means that we're able to take advantage of where places interest rates are going up, and the fund is able to short sell the securities in that market and make money even in a rising interest rate environment, as well as make money through traditional methods of managing bond portfolios. The fund has a yield of 3% and a duration of minus 0.3 years. This fund has the potential to go to a negative duration of a fairly significantly larger number. It's been as large as minus 5 years historically, but currently it's almost neutral. However, if interest rates were to begin to rise, we expect this fund would go to a negative duration, which would then benefit, and it would likely make money in a rising interest rate environment. Next, we've added a closed-end strategic fund. This fund is a really interesting amalgamation of two different strategies. One, investing in closed-end bond funds, which are currently selling at a discount to their net asset value. We're in essence buying closed-end bond funds at 90 cents on the dollar, which we like because we're picking up pretty significant current yield, and if that gap narrows, we're able to pick up a potential up to a 10% capital appreciation if these get to parity with the current net asset value. Also, it has strategies from one of our favorite portfolio managers who runs a hedge fund for very, very high net worth and institutional clients, which has been very successful, but otherwise inaccessible to most investors, and he actually has a portion of the portfolio invested in this closed-end strategic fund. This fund has a yield of 5.2% and a duration of 3.4. So the 5.2 has boosted our yield again, and our duration has down to about 3.2 years. And lastly, we've added an emerging markets bond fund. Since this is a little bit more volatile investment, we have a small percentage in this fund. However, we think it's very attractive. The fund invests in emerging economies, but only in U.S. dollar-denominated bonds, and invests in sovereign, as well as, that is, the government bonds for these various emerging economies, as well as corporate bonds. The portfolio is a very high-quality portfolio and has a yield of 5.3%. and a duration of 5.8. So to the right, you can see now we've finalized the overall portfolio having a yield of 3.4% and a duration of 3.3 years. Let's compare that now again to where we started from, which was comparing to the overall bond market, in this case the Vanguard Total Bond Market Index Fund. And if we compare that to the overall bond market, which I showed you earlier, the Brower-Janikowski fixed income portfolio, which we just constructed, 3.4% yield, 3.3-year duration, versus the broad bond market having a yield of 2% with a duration of 5.6%. In our view, this is a very attractive position to be in with where interest rates and where the bond market is now. We're yielding about 170% of what the bond market's yielding, and we have just a little over half the bond market interest rate risk with a much shorter duration. So to summarize the material we've covered so far in this webinar today, we believe the Fed Reserve will raise short-term interest rates with the Fed's funds rates. It's fully justified. It's artificially low. They're going to bring it up over a period of time, 2 to 3% in our view. It might take several years for that to happen, and it may not start right away because the Fed is very nervous about how it may affect the stock market and also the bond market and the economy. So in our view, the Fed is going to tread very, very gingerly and gently in raising interest rates. We may not see the first interest rate increase until near the end of this year, possibly even into next year, especially if the economy doesn't appear to be picking up speed. Also, inflation is very low and likely to remain subdued for some time. The economy also, growth is very subdued and not growing very rapidly, which again leads us to believe that there is no real pressure on longer term and intermediate term interest rates in fixed income markets and for bonds. So our view is that there's not huge risk in rising rates on intermediate and long-term bonds, and that the yields are likely to remain relatively low volatility. Where we do see volatility, though, is in short-term bonds. And as the Fed Reserve begins to raise rates, we do believe that you will see rates on money market funds, CDs, short-term treasury bills going up pretty dramatically. And so for that reason, we're not necessarily fans of being invested in the very short-term end of that yield curve that I mentioned, and have positioned ourselves a little bit further out. But again, we're keeping the duration relatively low so that if bad things happen in the economy on a global basis and there are interest rate spikes or shocks, we're well protected from interest rate spikes. And we believe that the portfolio, there's some really nice opportunities, which we mentioned with the River North Fund, the Double Line Emerging Markets Bond Fund, and also the ability of the GS Strategic Income Fund to be very strategic and tactical. That fund has the ability to go even shorter or a further negative in duration, which can help moderate the overall maturity of the portfolio when the time comes. So this concludes this presentation. I hope you found it useful, and we intend to have a client event every month, and we tend to move these around the Bay Area so that we hit different geographic areas, so it makes it convenient for people to come to various events. The topics will be announced prior to the client event. We don't announce them way in advance because we like to see what's current, what's most interesting, and we'll choose a topic generally a few weeks out from the event. You're welcome to go to any of the events. Even if you live in the South Bay, you're welcome to come to any of the other events, and vice versa. And no matter where you live in the Bay Area, you're welcome to go to any of the events. And again, we have clients who are not in the state and not even in the country, and hence we will attempt to record a version of the client event so that they can listen in on the subjects in a webinar, which we'll post on our website shortly after the client event. So thanks very much for listening. I hope this was useful and helpful and possibly enjoyable, and we look forward to seeing you at one of our client events. If you have any questions on the presentation, suggest that you contact your financial advisor at Brown Janikowski, and they'd be happy to answer any questions you have. So thanks very much, and have a fantastic day. Take care.